Welcome back to the Wall Street Podcast. Today, August 22, 2025, we're doing a deep dive into some critical insights from the Wall Street Journal's latest reporting.
That's right. We're looking at some pretty significant shifts: monetary policy, industry dynamics, economic indicators.
Exactly. Things that really demand attention right now. The Journal's report touches on the Fed's strategy, trade relations, the economy's health.
And importantly, how these things are all connected. Fed policy, trade, consumer spending, it's all linked.
So let's start with the Fed. Sounds like a major pivot is coming on monetary policy.
Yes, it seems the Federal Reserve is preparing to overhaul its approach to setting interest rates. They're planning to scrap that framework they set up back in 2020.
The one focused on average inflation targeting, I remember that. Some argue it contributed to the delay in reacting to rising prices.
Precisely. And Fed Chair Powell is expected to detail the changes soon, likely at the Jackson Hole Symposium.
That's always a key event for policy announcements. So the aim here is to tackle the high volatile inflation we've seen.
That seems to be the core goal. But, there's internal division. It's not straightforward.
Oh, what kind of division?
Well, some officials are apparently pushing for rate cuts sooner rather than later to support the labor market.
Okay, concerned about a slowdown there.
Right. But others are pointing to rising service prices and saying, hold on, maybe it's too soon to cut.
So a real debate happening internally. What does this shift really signal for the markets then?
I think it signals first an acknowledgement that the old framework maybe wasn't ideal for the shocks we experienced. It suggests a more flexible Fed going forward.
More data dependent, perhaps?
Exactly. But that also means continued uncertainty, doesn't it? They're trying to balance inflation, a cooling labor market, plus tariffs, AI impacts. It's a lot to navigate.
Okay, so that's the monetary side. Let's pivot, as you said, to industry and trade. The Journal mentions the government getting more hands-on.
Yes, particularly with the CHIPS Act funds from 2022. The administration is reportedly considering taking equity stakes in some companies receiving that money.
Equity stakes, like owning part of the company.
Potentially. The example given was a possible 10% stake in Intel.
Interesting. Is that across the board?
Apparently not. The report suggests no plans for stakes in, say, TSMC or Micron, firms that are already boosting their U.S. investment significantly.
Okay. And what about trade tariffs? Still a factor.
Very much so. The U.S. is set to maintain those 27.5% tariffs on EU cars until the EU lowers its own levies on U.S. goods.
So still some tension there.
Mm-hmm. And interestingly, Swiss watch exports actually ticked up in July.
Oh, why is that?
It seems brands were accelerating shipments ahead of new U.S. tariffs kicking in, which recently went up to 39%.
Wow, 39%. So if we step back, what's the big takeaway for businesses regarding this government involvement?
Well, looks like businesses need to prepare for potentially more federal influence. Subsidies might come with strings, like equity.
And trade terms will continue to be a point of negotiation, sometimes aggressive negotiation.
Right. It really underscores the need for strategic planning around supply chains, policy compliance. We see it impacting semiconductors, auto, even luxury goods like watches.
Okay, let's bring this down to the broader economic pulse. What's happening with hiring and consumers?
There are signs of slowing. A Conference Board survey found about 1 in 5 U.S. employers plans to slow hiring in the second half of this year.
1 in 5, how does that compare?
It's nearly double the percentage from just a year ago. We're seeing examples, too, like Novo Nordisk freezing hiring in some areas.
And retail, how are big players handling things like tariffs?
It's mixed. Walmart, for instance, actually missed earnings targets, but seems to be absorbing some tariff costs to stay competitive on price.
Trying to hold on to market share.
Seems like it. Meanwhile, Amazon reported an 11% jump in online store sales. So online is still strong there.
But what about the consumers facing these potential price increases?
They're reacting. The data suggests people are pulling back on discretionary spending, the non-essential items. Budgets seem tighter.
Makes sense. Amidst all this pressure, is there any area seeing strong investment?
Yes, actually. AI in healthcare. Venture capital funding saw a big rebound there, hitting about $7.9 billion in the first half of 2025.
$7.9 billion, that's significant.
It is. Firms like Coventus and Ambience Healthcare raised substantial rounds. It shows that innovation, especially around efficiency and tech, is still attracting serious capital.
So, thinking about how corporations and tech are adapting, large retailers are using strategy, absorbing costs maybe, while consumers adjust their budgets.
Correct. And at the same time, you have this powerful wave of investment into specific technologies like AI, particularly in sectors like healthcare, looking for efficiency gains.
So pulling this all together, how does this directly impact our listeners, the general public?
It touches everyone. Those Fed policy shifts we discuss,
Yeah.
they can directly influence mortgage rates, the returns on your savings and investment.
Right. Higher or lower borrowing costs.
Yeah, exactly. And trade tariffs. They show up in the prices you pay. Cars, electronics, everyday goods, potentially.
And the job market shifts, the hiring slowdowns, that affects career opportunities, job security.
Definitely. Plus, the advancements in AI, like in healthcare, will eventually shape the services you receive, maybe even future job roles.
It really highlights how interconnected everything is, from Jackson Hole policy debates to the price tags at the store.
Absolutely. Understanding these threads, policy, trade, consumer behavior, innovation, is really crucial for navigating the financial landscape right now.
So it's important for everyone to consider how these decisions and market responses might play out for their own long-term economic outlook.
And their personal financial strategies, too. It's worth reflecting on how these larger forces might shape your own plans.